Hello, everyone, and welcome to this exciting journey into the fascinating world of crypto and blockchain. Today, we're going to explore what blockchain really is and how it has become a groundbreaking technology that is changing the way we think about finance, data, and trust in the modern era. To begin, let's start with the basics. Blockchain might sound like a complex technical term that belongs only in the realm of computer experts or cryptocurrencies, but at its core, it's something quite simple and revolutionary. Imagine a digital ledger, much like a notebook used to record transactions. But instead of being kept by one person or organization, this ledger is distributed across thousands of computers around the world. Every transaction, every entry is recorded in a way that is secure, transparent, and nearly impossible to tamper with. That's what makes blockchain technology so special. Its design ensures that once information is recorded, it cannot be changed or deleted without everyone else knowing. This level of security and transparency is something traditional databases or ledgers usually cannot match. Because blockchain ledgers are maintained collectively by a network of computers, they eliminate the need for a central authority, such as a bank or government, to verify or approve transactions. So, why is this important? Well, blockchain technology laid the foundation for cryptocurrencies, the most famous of which is Bitcoin. Cryptocurrencies are digital currencies that use blockchain to record and verify transactions securely and without the need for a middleman. This is a big deal because before blockchain, digital money often depended on banks or payment companies to confirm transactions. Blockchain changed that by allowing people to send money directly to one another anywhere in the world almost instantly and with lower fees. But blockchain's impact goes far beyond money. It has opened up new possibilities in fields like supply chain management, voting systems, healthcare, and even digital identity verification. Thanks to blockchain, businesses and governments are exploring ways to make their processes more transparent, efficient, and trustworthy. The technology offers a way to build systems where everyone can verify the data independently, making fraud or manipulation much harder. In this video series, we will start from the early beginnings of blockchain and cryptocurrency. We will talk about the initial ideas that inspired the technology, the challenges that developers faced, and how Bitcoin emerged as the first practical application of blockchain. From there, we'll move on to modern developments, including the rise of other cryptocurrencies like Ethereum, smart contracts, decentralized finance, often called DeFi, and how blockchain is shaping the future of technology and innovation. By the end of this journey, you will have a clear understanding of what blockchain and crypto are, why they matter, and how they might influence our world moving forward. Whether you have heard about Bitcoin and wondered what all the fuss is about, or you are curious to learn how this digital revolution works, this story will break it down in a way that's easy to follow. So buckle up as we dive into the digital ledger that is transforming trust and technology, changing the way we exchange value and information in the 21st century. Welcome to the world of blockchain and crypto.
To understand the roots of blockchain technology, we need to look back several decades into the world of cryptography and early digital currencies. Before anyone talked about blockchain as we know it today, there were important ideas shaping the way we could secure information in the digital age. Cryptography, which is the art of writing and solving codes, was one of the key building blocks. It allowed people to protect information so only the right people could see it. This was especially important as computers and the internet started becoming more common. In the early 1990s, two researchers named Stuart Haber and W. Scott Stornetta made a breakthrough that set the stage for what would become blockchain technology. They were focused on a problem related to digital documents: how to prove that a document existed at a specific time and had not been tampered with after it was created. This is something we take for granted in the physical world. For example, a notarized document has a date and signature that verify its authenticity. But how do you do that with files or information stored on a computer, which can be easily copied or changed? Haber and Stornetta came up with a clever solution. Their idea was to use a process called time stamping that would create an unchangeable record showing when a document was created. They used cryptographic techniques to create a kind of digital fingerprint for each document. This fingerprint is called a hash, and it works like a unique code that changes completely even if just one tiny part of the document changes. By linking these hashes together in a chain, meaning each new hash included information from the previous one, they created a way to make sure none of the documents could be altered without it being obvious. What made their concept especially strong was the idea of a decentralized chain. Instead of keeping these records in one central place, which could be hacked or altered by someone with access, they imagined a distributed system. In a decentralized system, copies of the chain are spread out across many computers or nodes, so no single party has control. This makes the whole system much more secure, because to change even one record, a hacker would need to change all the copies at the same time, which is practically impossible. Think of it like a group of friends each having a notebook with the same list of events written in the same order. If one friend tries to change something, the others still have the original notes, so they can spot the difference immediately. Haber and Stornetta's work showed how this chain of blocks, each containing linked information secured with cryptography, could ensure data stayed trustworthy and safe over time. These ideas of time-stamped documents, linked securely and shared across computers, inspired later innovations.
When Bitcoin emerged more than a decade later, it built directly upon these concepts. Bitcoin's public ledger, or blockchain as we call it now, is essentially a massive decentralized chain of blocks, each containing transactions hashed and linked to the previous block. To sum up, the early work of these pioneers showed us that combining cryptography with a decentralized chain structure could solve the pressing problem of digital trust. They introduced the core idea that data could be securely recorded and verified without relying on a central authority. This was revolutionary. It was the conceptual seed that grew into the blockchain technology powering cryptocurrencies, smart contracts, and countless other innovations today. These foundational concepts remind us that breakthroughs often start with simple but powerful ideas, like time-stamping a document, and evolve into systems that can transform entire industries. Understanding this history helps us appreciate how far we've come and why blockchain technology holds such promise for the future. To understand the story of Bitcoin, we need to start with a mysterious figure named Satoshi Nakamoto. In October 2008, someone using this name published a document called the Bitcoin White Paper. This paper was titled Bitcoin, a peer-to-peer electronic cash system. It was the first detailed description of a brand new type of money, digital, decentralized, and designed to work without banks or governments. Even today, nobody knows who Satoshi Nakamoto really is. The name might be a single person, or it could be a group of people working together. Satoshi's true identity remains one of the biggest mysteries in the tech world. But what is clear from the white paper is that whoever Satoshi was, they understood the problems with the old financial systems and wanted to create a better way for people to send money directly to each other. Back then, when you wanted to send money digitally, you usually had to go through a bank or a payment service. These middlemen controlled the process, charged fees, and sometimes took a long time to approve transactions. Plus, in times of crisis, governments or banks could freeze accounts or block transfers. Satoshi wanted to create a system that avoided all these issues by removing the middleman entirely. The idea was simple but revolutionary. What if people could send value directly to one another, using a digital currency without needing a bank to confirm or approve the transaction? To do this, Nakamoto introduced a decentralized network where computers around the world could work together to verify and record transactions. This was the birth of Bitcoin. At the core of this system is something called the blockchain. The blockchain is like a public ledger, a record that everyone can see and verify, but no one can change or cheat. Each time someone sends Bitcoin to a friend, a new entry is added to this ledger. Everyone who participates in the network can check that the transaction is legitimate, preventing problems like double spending, where someone might try to spend the same digital coin more than once. The blockchain is made up of blocks, each containing a list of recent transactions. These blocks are linked together in a chain, hence the name. Once a block is added, it is extremely difficult to change, because altering one block would require changing all the blocks after it, which would need a huge amount of computer power. This is what makes Bitcoin's system secure and trustworthy, even though no single person or institution controls it. Another key part of Nakamoto's design was using something called proof of work. This means that to add a block to the chain, computers on the network have to solve a very hard math problem. This process is called mining, and the computers that do this work are called miners. Solving the math puzzle takes time and electricity, which helps keep the network running smoothly and prevents cheating. In return, miners earn newly created bitcoins as a reward. This way, more bitcoins come into circulation gradually at a steady and predictable rate.
When Nakamoto published the white paper, the idea was exciting, but also strange to many people. The internet was already full of talk about digital money and e-cash, but none of the previous attempts had solved the big problems of trust and security without relying on banks. Bitcoin promised a new hope, a way to move money freely and safely without asking permission from anyone. The first version of Bitcoin software was released in early 2009. Nakamoto mined the first block of Bitcoin, known as the Genesis block, and included a message referencing a headline about financial bailouts. This showed a clear statement of purpose. Bitcoin was born as an answer to the failures of traditional banking systems during the global financial crisis. At first, only a handful of people knew about Bitcoin or cared to try it. The early adopters were mostly cryptography enthusiasts, programmers, and people interested in creating a new kind of money. It took time for Bitcoin to grow beyond this small group, but the fact that the network was running smoothly and that no one could control or shut it down was already an impressive achievement. During this early period, Satoshi Nakamoto communicated with other developers through online forums and emails, but remained anonymous, never revealing any personal details. In 2010, Nakamoto gradually handed over control to other members of the Bitcoin community and then disappeared completely. Their last known online communication was around April 2011. Since then, many people have tried to uncover who Nakamoto really might be. Some suggesting individual programmers, others groups, or even government agencies, but the identity remains unknown, and perhaps this is how Nakamoto wanted it. The focus has stayed on the technology itself and how it can change the way we think about money. In the years after Nakamoto vanished, Bitcoin continued to grow. More people started using it, businesses accepted it as payment, and developers improved the software. The idea of a decentralized digital currency was no longer just a theory in a white paper. It became a real, functioning system trusted by many around the world. So the birth of Bitcoin was not just about creating a new kind of money. It was about challenging the old financial order, building trust through technology instead of institutions, and giving people a choice to control their own money on their own terms. And it all began with one simple but powerful document, the Bitcoin white paper, and the mystery of its author, Satoshi Nakamoto.
When Bitcoin first launched in 2009, it was like a tiny spark in a huge dark forest. The idea of a digital currency that wasn't controlled by any bank or government was new and exciting, but most people didn't know what to make of it. The very first Bitcoins were created through a process called mining. Mining back then wasn't what it is today with huge machines and powerful computers. It was mostly hobbyists and cryptography enthusiasts running software on their regular computers, trying to solve puzzles that would unlock new Bitcoins. The very first block ever mined, known as the Genesis block, came with a special message embedded in it, a kind of timestamp saying, "The Times, 03 Jan 2009,
chancellor on brink of second bailout for banks. This was a clear nod to why Bitcoin was created, to provide an alternative to the messy, risky financial systems people had grown frustrated with. In those early days, Bitcoin had no real-world value. It was just a digital experiment. That changed in May 2010, when something extraordinary happened. The first documented purchase using Bitcoin. A programmer named Laszlo Hanyecz wanted to show that Bitcoin could actually be used as money. So he offered 10,000 Bitcoins to anyone who would order him 2 pizzas. Someone took him up on the offer, and a pizza delivery guy showed up at his door. This might seem like a simple, funny story now, but at the time, it was the first time Bitcoin was used to buy something tangible. Today, those 10,000 Bitcoins would be worth millions of dollars. But back then, they were just an experiment, the beginning of Bitcoin's journey from code to currency. Even with the famous pizza transaction, Bitcoin's path wasn't easy. Many people were skeptical. Why use digital coins that no government backed? How could it be secure? What if someone deleted parts of the blockchain? Bitcoin was misunderstood, and there were few places where you could spend it. Online forums and small websites were the main places where Bitcoin was accepted. Developers and enthusiasts carried the torch, discussing, improving the code, and building infrastructure to support the growing network of users. They created wallets to store Bitcoins safely, and exchanges where people could trade Bitcoins for other currencies. It was a slow and cautious climb. Bitcoin's community grew steadily. From a handful of programmers, it expanded to include people interested in libertarian ideas, tech geeks fascinated by blockchain technology, and even some early investors looking for something new. The community was key because Bitcoin isn't run by any one company or person. Instead, it relies on people all around the world who support it, maintain the software, and operate the network. Over time, the code was improved to fix bugs, increase security, and make mining fairer.
Many exchanges went offline or were hacked, leading to losses and doubts. Still, the community pushed forward, learning from mistakes and becoming more resilient. Slowly, businesses and individuals started to realize the potential of Bitcoin. It was borderless, easy to send to anyone in the world, and protected against censorship and inflation. These early supporters were pioneers, experimenting with this new kind of money and believing in its promise. By the end of 2011, Bitcoin's popularity was growing beyond just developers and hobbyists. More online merchants started accepting Bitcoin, and media coverage helped spread the word. Bitcoin became a topic of conversation in tech circles and financial communities. While it was far from mainstream, its rising user base and the expanding network of miners and developers gave Bitcoin a foundation to build on. In summary, the early days of Bitcoin were marked by small steps but significant breakthroughs. Mining started as a curious experiment, but it laid the groundwork for the entire system. The famous pizza transaction showed that Bitcoin could be real money used in everyday life. Despite doubts and difficulties, a vibrant community grew, fueled by passion and innovation. This strong and dedicated group, combined with Bitcoin's unique design, allowed it to survive tough beginnings and slowly gain popularity. The story of Bitcoin's first transactions and its early users is a powerful reminder of how a simple idea, when nurtured by a community, can grow into something revolutionary.
With Bitcoin laying the groundwork, it didn't take long for other digital currencies to start appearing. These new coins, often called altcoins, tried to fix some of Bitcoin's bumps and build on its success. One of the earliest and most famous altcoins was Litecoin. Created by Charlie Lee in 2011, Litecoin aimed to be the silver to Bitcoin's gold. It introduced some subtle but important changes. For example, Litecoin's transactions got confirmed faster. Instead of Bitcoin's roughly 10-minute block time, Litecoin cut this down to about 2.5 minutes. This meant you didn't have to wait as long to see your payment go through. It also used a different mining algorithm called Script, designed to be more accessible to ordinary users than Bitcoin's SHA-256, which favored specialized hardware. But Litecoin was just the beginning. Many other altcoins soon appeared, each with their own ideas about how to improve on Bitcoin. Some focused on making payments even quicker and cheaper. Others tried to offer better privacy features for users who wanted more secrecy in their transactions. Take Dash, for example, which introduced features like Instant Send to speed up payments and Private Send for more anonymity, allowing users to mix their coins and confuse anyone trying to trace them. At the same time, the technology underpinning these digital currencies, blockchain, started evolving beyond just moving money from one person to another. People realized this amazing system of guaranteed trust and security without needing a middleman could do so much more. This led to innovations in how blockchains worked under the hood. One big area of development was different ways to agree on the state of the blockchain, or consensus mechanisms. Bitcoin's method, called proof of work, involved miners solving complex puzzles to add new blocks. It's secure, but can use a lot of electricity. To address this, other coins tested new approaches. For example, proof of stake lets holders of the coin validate blocks, reducing energy use and speeding things up. Beyond transactions and mining methods, blockchain technology started supporting smart contracts. These are self-executing contracts where the rules and outcomes are written right into the code. Ethereum, launched in 2015, was the first major blockchain designed specifically to run smart contracts. This opened up a world of possibilities. Suddenly, blockchain wasn't just about moving money, it could be used to create decentralized applications, automate agreements, and build complex systems without relying on any central authority. The rise of altcoins also spurred more experiments with what blockchains could do. Some focused on making transactions private through special encryption. Others created completely new types of networks, aiming to support things like digital identity, supply chain tracking, or even voting systems.
This was the start of blockchain becoming a real platform for innovation, rather than just a way to send digital cash. It's important to understand how this evolution was driven by the desire to overcome Bitcoin's limitations. Bitcoin was revolutionary, but not perfect.
For example, the speed and cost of transactions became a concern as more people used it. Altcoins tried different ways to make payments faster and cheaper. They also worked on making networks more scalable, so they could handle many users at once without slowing down. In addition, altcoins explored different governance models. Bitcoin relied on a somewhat informal agreement among miners and developers, which sometimes made upgrading the system slow and contentious. Other projects experimented with voting systems or more structured ways for the community to decide on changes. Through all this, the core idea remained. Blockchain technology can offer trust and transparency in a digital world. By removing the need for central authorities, it lets people interact and transact directly, securely, and without middlemen. This was a fundamental shift, and it inspired a wave of creativity and experimentation. By the mid-2010s, the ecosystem had grown dramatically. Hundreds of altcoins competed, collaborated, and learned from each other. The technology rapidly matured. Some altcoins faded away, but others laid down the foundations for future breakthroughs. In summary, the rise of altcoins and ongoing blockchain innovation opened the door to much more than just digital money. They introduced faster transactions, different ways to secure networks, and smart contract platforms that unlocked new use cases. This period set the stage for blockchain to move into new industries and reshape how we think about trust, ownership, and cooperation in the digital age. It was the start of a new chapter, one filled with endless potential, still unfolding today.
In the year 2015, an important moment arrived in the world of technology and finance. This moment was the launch of Ethereum, a new kind of blockchain platform. Ethereum was created by a young programmer named Vitalik Buterin. He had a vision beyond just using blockchain to record simple transactions. Vitalik imagined a place where computer programs could run exactly as written, without any chance of fraud, censorship, or interference from a third party. This idea was revolutionary and opened the door to something very new and exciting. At the heart of Ethereum's innovation were smart contracts. You might wonder, what exactly is a smart contract? We'll think of a smart contract as a computer program that lives on the blockchain. This program runs automatically when certain conditions are met. Unlike traditional contracts written on paper, these smart contracts do not need lawyers or judges to enforce them. Instead, the terms are coded into the program itself, making agreements trustless. This means people don't have to trust each other because they trust the code and the Ethereum network to do what it says it will do. Imagine you want to buy a car from someone online. Usually, you might need to trust that the seller will send the car after you pay. But with a smart contract, you can set up a program to hold your money safely until the car is delivered. Once the car is confirmed to be in your hands, the smart contract automatically releases the money to the seller. If the car doesn't arrive, the money is returned to you. All this happens without a bank, lawyer, or middleman. The contract runs by itself on Ethereum, making the process fair and secure. Ethereum's ability to run these smart contracts was a huge step forward. But there was even more to it. Because developers could program these contracts, they were able to create decentralized applications, called dApps for short. These dApps aren't controlled by a single company or person. Instead, they run on thousands of computers around the world, connected by the Ethereum blockchain. This makes dApps resistant to censorship and downtime. Developers started creating games, finance tools, voting systems, and many other kinds of applications on Ethereum. This was a big change from earlier blockchains, which mostly focused on sending money back and forth like digital cash. Now, with Ethereum, the blockchain was no longer just for transactions. It became a platform for running complex programs that could do many different things. This transformation had a massive impact. It shifted the blockchain landscape from simple tools that moved money to powerful systems capable of automating complex agreements and processes. Businesses and innovators began to see the possibilities. They no longer had to rely on traditional systems that could be slow, expensive, or controlled by a few entities. Instead, they could build new kinds of services that were open, transparent, and automated.
In summary, Ethereum changed the game by introducing smart contracts and enabling developers to build decentralized applications. This created a new era where the blockchain wasn't just a ledger of transactions, but a programmable platform for trustless agreements and innovations. This moment marked the beginning of a new chapter in technology, one that continues to grow and inspire people around the world today.
As blockchain technology grew and found its footing beyond just digital money, people started to see it as a powerful tool for many different industries. It wasn't just about cryptocurrency anymore. Blockchain began spreading its wings into areas like supply chain management, healthcare, and even voting systems. These new uses showed that blockchain could help make things clearer, safer, and more trustworthy. Let's start with supply chains. Imagine all the things you buy, from food to electronics. They often travel a long way, passing through many hands: farmers, factories, warehouses, trucks, and stores. Sometimes it's hard to know exactly where things came from or if they're real and safe. Blockchain provides a way to track every step, like a digital diary that can't be changed. Big companies like Walmart and Maersk have been testing blockchain to keep better records on their products. For example, Walmart used blockchain to trace the source of leafy greens to quickly handle any food safety issues. This kind of transparency helps both businesses and customers to trust what they buy. In healthcare, blockchain is opening new doors too. Patient records are often scattered across hospitals, clinics, and labs, making it tough to access and share accurate health information. With blockchain, a patient's medical information can be stored securely and only shared with the right people. This could reduce mistakes and speed up treatment. Companies like Medical Chain and Burst IQ are working on blockchain platforms for managing health records. Beyond just storing data, blockchain can help track the supplies of medicines and vaccines to prevent fraud and counterfeiting, ensuring patients get genuine products. The secure nature of blockchain is especially valuable here because health data is very sensitive. Voting is another area where blockchain is making waves. Elections need to be fair and transparent, but sometimes doubts arise about whether votes are counted correctly or if the process has weaknesses. Some governments and organizations have started experimenting with blockchain-based voting systems. The idea is that votes can be recorded on a blockchain, making them tamper-proof and easy to verify. For example, Estonia has been a leader in digital voting and has explored blockchain to further protect election data. Blockchain voting could make elections more accessible and trustworthy, though challenges like privacy and technical access still need work. These applications show how blockchain's core features, its decentralization, security, and transparency, can benefit many industries beyond currency. By giving everyone a clear record that can't be altered, blockchain promotes honesty and accountability. But with these new uses come challenges too. Blockchain systems can require significant computing power, which might make them expensive or slow for some tasks. Integrating blockchain with existing technologies and regulations is another hurdle. Plus, for new industries to trust and adopt blockchain, people need to understand how it works and be confident it's reliable. In spite of these challenges, the potential benefits are huge. More transparent supply chains mean fewer fake or unsafe products. Secure health records mean better care and privacy.
Reliable voting systems mean stronger democracies. These uses are only the beginning. As the technology matures and more companies and governments experiment, we're likely to see blockchain becoming an important part of everyday life, far beyond cryptocurrency. It might quietly work behind the scenes, making many of our systems safer and more honest, changing how we live in subtle but lasting ways. By the time 2017 rolled around, something remarkable was happening in the world of cryptocurrency. The market was buzzing with excitement and endless possibilities. One of the main stars of this boom was a new fundraising method called initial coin offerings, or ICOs for short. ICOs quickly became the hottest way for blockchain projects to raise money, attracting investors from all walks of life, eager to get a piece of what they hoped would be the next big thing. Now, ICOs were a bit like an initial public offering. That is, when a company sells shares of stock to the public for the first time. But instead of traditional stock, ICOs offered digital tokens that could represent a stake in the project or provide some kind of future access to the product or service. The idea was simple. A startup would create a new cryptocurrency token, explain their vision and technology in a white paper, and then invite the public to buy these tokens, often in exchange for more established cryptocurrencies like Bitcoin or Ethereum.
The appeal was enormous. For entrepreneurs, ICOs opened the door to raise funds more quickly and with fewer traditional barriers than going through banks or venture capitalists. For investors, ICOs offered a chance to get in early on projects that could potentially revolutionize industries like finance, supply chain management, and even social media. It felt like a gold rush where everyone wanted to find the next Bitcoin or Ethereum. Investment poured in at an astounding rate. In 2017 alone, ICOs raised billions of dollars worldwide. Some projects raised tens of millions within minutes. Stories of small-time investors turning modest contributions into huge returns spread quickly, fueling even more enthusiasm. The press was filled with headlines about blockchain startups raising huge sums and the promise of decentralized cutting-edge technology changing the world. But with all this excitement, there was also a shadow side. Not every ICO was built on solid ground. Because of the lack of clear regulation at the time, the door was wide open for scams and poorly thought-out projects. Some ICOs were nothing more than clever illusions designed to raise money and disappear, leaving investors empty-handed. Others promised revolutionary technology, but failed to deliver or simply lacked a clear business plan. As the craze intensified, skepticism grew. Regulators around the world started to take notice. They worried about investor protection and the potential for fraud. The U.S. Securities and Exchange Commission, among others, began issuing warnings and cracking down on fraudulent ICOs. This sparked a backlash that cooled the market, with many investors becoming more cautious and some projects struggling to maintain their momentum. Despite the ups and downs, ICOs left a lasting mark on the blockchain industry. They proved that it was possible to raise substantial capital directly from a global community, bypassing traditional financial gatekeepers. This democratization of fundraising pushed the industry to evolve.
It highlighted the need for clearer rules and better standards to protect investors and ensure quality projects. In response, many blockchain companies started moving toward more regulated approaches. Security token offerings, or STOs, gained attention as a more compliant way to offer tokens, often backed by real assets and adhering to securities laws. At the same time, initial exchange offerings, or IEOs, emerged, where cryptocurrency exchanges would vet projects before listing their tokens for sale, adding an extra layer of trust. Looking back, the ICO boom of 2017 was a wild and formative chapter in cryptocurrency history. It was a time of breathtaking opportunity and notable risk, a reminder that innovation often comes with growing pains. The excitement and challenges of that period helped shape the path the industry would take, encouraging strong technology development, sparking global interest, and prompting the important conversations around regulation and investor protection that continue to this day.
As we continue to explore the challenges faced in the blockchain world, one of the most dramatic moments in crypto history was the collapse of Mt. Gox. Back in 2014, Mt. Gox was the largest Bitcoin exchange, handling over 70% of all Bitcoin transactions worldwide. Imagine having a wallet that almost everyone trusted to hold and trade their Bitcoins. Suddenly, millions of dollars worth of Bitcoin went missing. Mt. Gox announced it had lost approximately 850,000 Bitcoins, which was an enormous shock to the crypto community. This hack, or internal theft, depending on who you ask, led to bankruptcy and threw a huge shadow of doubt over the safety and reliability of cryptocurrency exchanges. This event was more than just a loss of money. It severely damaged trust in the entire crypto ecosystem. People who believed in blockchain technology started to question if these digital currencies were safe. If one of the biggest exchanges could be hacked or mismanaged, where did that leave regular investors? The MTGOX failure pushed many to call for better security, more transparency, and clear regulations to protect investors and users. Speaking of security and trust, there have been several other exchange failures since then, each adding its own layer of concern. For example, exchanges like Quadriga CX faced their own crises, where mismanagement and suspicious circumstances led to millions in customer funds being inaccessible or lost. These incidents reinforced worries about the centralized points of failure in an otherwise decentralized landscape. It made the community think, can we truly rely on these exchanges to be responsible custodians of our digital assets? Another heated debate that often lights up discussions is around the environmental impact of cryptocurrencies, especially those using proof-of-work systems like Bitcoin. Proof of work is a method used to validate transactions and secure the blockchain by requiring miners to solve complex mathematical puzzles. While this method makes the network secure and decentralized, it also consumes a staggering amount of energy. Critics argue that Bitcoin mining uses more electricity annually than some entire countries. This has raised alarms, especially as the world is fighting climate change and trying to reduce carbon emissions. People worry about the huge carbon footprint that proof-of-work mining leaves behind. On the other hand, supporters say that the Bitcoin network is pushing for cleaner energy solutions, and that mining often uses excess or renewable energy that would otherwise go to waste. The debate continues as some cryptocurrencies try alternative methods like proof of stake, which uses a lot less energy. These discussions are essential because they influence how the technology evolves and whether it can be sustainable in the long term. Another big challenge facing blockchain is the issue of government regulations and legal uncertainty. Around the world, governments are struggling to figure out how to deal with cryptocurrencies. Different countries have taken vastly different approaches. Some have embraced it, crafting clear rules for exchanges and users, while others have banned or heavily restricted crypto activities altogether.
This patchwork of regulations creates confusion and risks for businesses and investors alike. It's hard to operate or invest when the rules keep changing or when certain financial activities are considered illegal in one place but legal in another. Governments are concerned about cryptocurrencies being used for illegal activities like money laundering, tax evasion, or financing terrorism. As a result, many authorities are increasing their oversight and enforcing strict compliance requirements. At the same time, crypto advocates argue that too much government control could suffocate innovation or turn these decentralized technologies into centralized systems again. Striking the right balance remains a work in progress, and we're likely to see regulatory frameworks continue evolving in the years ahead. Privacy is another tricky topic in blockchain discussions. One of the early promises of cryptocurrencies was that they would offer privacy to users, allowing people to send money or store value without revealing their identity. Bitcoin
and many other blockchains offer a certain level of pseudonymity. Users have addresses, but not personal names attached. But because every transaction is recorded on a public, unchangeable ledger, anyone can trace the movement of funds from one address to another. This transparency is a double-edged sword. It helps prevent fraud and builds trust by making transactions visible, but it also means privacy is limited. People worried about their financial activities being tracked by governments, companies, or hackers started looking for solutions. This led to the creation of privacy-focused cryptocurrencies like Monero and Zcash. These coins use advanced cryptographic techniques to hide transaction details, protecting users' anonymity. However, privacy coins have drawn negative attention from regulators because their secrecy can help criminals hide illicit transactions. The ongoing challenge for the blockchain community is finding the right balance between transparency and privacy. Too much transparency risks users' privacy and security. Too much anonymity could encourage illegal activities. It's an ongoing tension that the technology and the industry still struggle to resolve. In summary, the blockchain world has been shaped by a series of big controversies and difficult challenges. From the shocking losses of exchanges like Mt. Gox to global debates over energy use, regulatory hurdles, and privacy concerns, these issues have tested the resilience and promise of blockchain technology. But through it all, the community continues to innovate, learn, and adapt. These struggles remind us that even breakthrough technologies face obstacles on their way to becoming truly transformative forces. As the blockchain story continues, it's important to understand both the exciting potential and the real challenges that come with this technology. Only by facing these head-on can blockchain live up to its promise of revolutionizing finance, identity, and many other parts of our lives.
Now, let's dive into the real heart of the story, the rise of decentralized finance, or DeFi, and how it reshaped the financial landscape starting around 2020. Imagine a world where you can lend money, borrow cash, trade assets, and even earn interest, all without going through a bank or any traditional middleman. Sounds a bit like science fiction, right? Well, thanks to DeFi platforms, this became a reality. So what makes DeFi so special? The magic lies in two powerful technologies: blockchain and smart contracts. Blockchain is like a giant shared notebook that everyone can see and verify, but no one can change without consensus. It's secure, transparent, and most importantly, decentralized, meaning no single company or government controls it. Smart contracts are self-executing pieces of code that live on the blockchain, automatically enforcing agreements without needing lawyers or banks. Think of them as little digital robots that make sure everyone plays by the rules. Before DeFi, traditional financial services depended heavily on intermediaries. If you wanted to borrow money, you'd go to a bank. If you wanted to trade stocks, you'd rely on brokers. These middlemen often had the power to set fees, decide who could participate, and sometimes they slowed things down or limited access. DeFi flips this model on its head. By using blockchain and smart contracts, it creates an open financial system accessible to anyone with an internet connection.
no permissions needed, no gatekeepers, and no borders. One of the first big breakthroughs in DeFi was the creation of platforms that allow lending and borrowing without banks. For example, if you own cryptocurrency but don't want to sell it, you can now lend it out on a DeFi platform and earn interest. Borrowers can secure loans by putting up their own cryptocurrency as collateral, all handled automatically by smart contracts. This kind of peer-to-peer lending was revolutionary because it lowered barriers, making financial services more inclusive and efficient. But lending was just the beginning. Soon, decentralized exchanges, often called DEXs, started popping up. These platforms let people trade cryptocurrencies directly with each other without an intermediary. Traditional exchanges held users' funds and acted as intermediaries, which carried risks like hacks or censorship. DEXs, on the other hand, allow users to keep control of their assets while trading. They use smart contracts to match buyers and sellers instantly, ensuring security and transparency. The year 2020 was a booming period for DeFi. As more people looked for alternatives beyond traditional finance, DeFi platforms saw explosive growth. Innovation came fast and furious. New protocols, new tokens, and new ways to earn and grow wealth appeared almost daily. Yield farming, for example, became a popular concept. It involves locking up cryptocurrency in DeFi protocols to earn rewards, sometimes in the form of new tokens. It was like getting paid to save your money, an attractive idea for many. This rapid growth wasn't just about numbers. It was about a vision of a truly open, decentralized financial ecosystem where anyone could participate regardless of location or background.
People started seeing DeFi not just as a curiosity, but as a real alternative to traditional systems. Investors poured billions in, and developers raced to build better, more user-friendly platforms. However, like all new frontiers, DeFi came with risks. The same openness that made it exciting also brought huge challenges. First, the prices of many DeFi tokens in cryptocurrencies were extremely volatile, meaning their values could swing wildly in a short time. This made investing and borrowing decisions risky for everyday users. Then there were security concerns. Smart contracts are just lines of code, and they can have bugs or vulnerabilities. Hackers targeted DeFi platforms with sophisticated attacks, sometimes draining millions of dollars in assets. Each hack served as a harsh reminder that while DeFi promised freedom and control, it also required users to be vigilant and informed. Another important challenge came from regulatory questions. Governments and financial authorities around the world began examining DeFi more closely, trying to figure out how to fit it into existing legal frameworks designed for traditional finance. Questions arose about consumer protection, money laundering risks, and tax compliance. Since DeFi operates in a decentralized manner, enforcement of regulations proved tricky. This uncertainty created a tension between innovation and oversight that continues to this day. Despite these challenges, DeFi's impact was undeniable. It showed the world that financial services could be reimagined from the ground up, powered by technology and open networks. It invited millions to participate in financial activities that were once out of reach. And it sparked a global movement,
inspiring countless projects and ongoing development. So, while the journey of DeFi is filled with promise and pitfalls, it's clear that it marked a significant chapter in the story of finance. It challenged old models, embraced transparency, and pushed the boundaries of what's possible when trust is built into code, rather than handed over to a few powerful players.
Now, let's dive into the heart of what makes NFTs truly fascinating: the concept of digital ownership. Before NFTs came along, owning something digital was kind of like having a picture on your phone or a song in a playlist. You could view it, listen to it, or share a copy, but it was hard to prove that you were the one true owner. Digital files could be copied endlessly, and the idea of owning something unique in the digital world felt almost impossible. This is where NFTs, or non-fungible tokens, introduce a whole new way of thinking about ownership. Non-fungible means something that is one of a kind. It can't be replaced with something else. For example, think about a painting. There's only one original Mona Lisa. Even if you have a poster of it, it's just a copy. An NFT acts like a certificate of authenticity for digital items, showing exactly who owns that unique piece. This certificate is stored on the blockchain, a special kind of digital ledger that's very secure and hard to tamper with. Because of this, NFTs guarantee the uniqueness and ownership of a digital asset. Let's take art, for example. When NFTs started trending in the world of digital art, it became possible for artists to sell their work directly to fans without needing galleries or auctions. Famous digital artist Beeple made headlines when one of his digital artworks was sold as an NFT for nearly $70 million. This shocked the whole art world because it was a digital file, something anyone could have downloaded online for free before the NFT sale. But with the NFT, there was a verified owner, and that changed everything. Artists began to get paid fairly for their digital creations, and collectors saw new value in owning digital art. Music also took a big leap with NFTs. Musicians started selling unique tracks or even special experiences as NFTs. Imagine owning a rare song that no one else has, or a VIP pass to a virtual concert, all verified on the blockchain. This gave artists new ways to connect with fans and make money without relying heavily on streaming platforms, which often pay very little per song played. Collectibles found a new home in the NFT space too. Digital trading cards, virtual pets, and in-game items took the idea of collecting to the next level. Instead of physical cards or toys, people began buying, selling, and trading one-of-a-kind digital items. For example, CryptoKitties became wildly popular. These are unique digital cats, each with its own look and traits, and their owners can trade or breed them just like physical pets. This led to a booming market, showing that people do value digital ownership and uniqueness when it's verified by technology. All these changes have challenged traditional ideas of ownership and creativity. Before NFTs, artists and creators often fought with issues like piracy, where copies of their work were shared without their permission and without payment.
NFTs help solve this by making ownership clearer and more enforceable. Plus, creators can program royalties into NFTs, meaning they earn a percentage every time their work changes hands in the future. This ongoing value creation was hard to do before NFTs.
However, NFTs have also sparked many debates. Some people question their true value, wondering if this is just a modern gold rush fueled by hype and speculation. Others worry about the environmental impact, since the technology behind blockchain uses lots of energy to verify transactions. It's important to talk about these concerns because they remind us that every new technology has its challenges and growing pains. Despite the mixed opinions, the cultural impact of NFTs is undeniable. They've opened up fresh conversations about what it means to own something in a digital world. People are becoming more aware that digital things can hold real value, just like physical ones. Museums have started including digital art in their collections, and celebrities are jumping on board to release unique digital experiences. This shows the power of NFTs to change how we think about creativity, value, and ownership. In the end, NFTs represent a big shift in technology and culture. They give us new tools to reward creativity and let people own unique pieces of the digital universe. While this new world is still developing, one thing is clear: NFTs have made digital ownership a real, exciting possibility that was hard to imagine just a few years ago. And as we move forward, we'll likely see even more ways that these digital tokens transform the way we create, share, and value the things we love.
As we look closer at the connection between blockchain and the future of the internet and virtual worlds, it becomes clear just how important this technology really is. Blockchain is more than just a tool to create cryptocurrencies like Bitcoin. It's the backbone for building something truly new and exciting, often called the metaverse and Web 3.0. The metaverse can be thought of as a vast digital universe where people can interact with each other, explore virtual environments, buy or sell digital items, and even attend events, all in real time. Unlike today's internet, where we mostly use websites controlled by big companies, the metaverse aims to be a shared space built by many users. And this is where blockchain takes center stage. Blockchain allows for a decentralized internet, meaning no single company or person owns everything. Instead, the network is spread across many computers around the world, making it open, transparent, and more secure. When you own a digital item on the blockchain, like a piece of art, a virtual land plot, or even an avatar outfit, that ownership is guaranteed by the technology. It cannot be taken away, copied, or changed without your permission. One exciting example is how companies and projects are creating virtual worlds using blockchain. Platforms like Decentralized and the Sandbox offer 3D spaces where users can buy, build, and sell digital land and experiences. These virtual worlds are not owned by a single company, but by the users themselves, thanks to smart contracts on the blockchain. People can create new games, art galleries, or even virtual shops, and earn real money through these digital economies. Moreover, blockchain gives users control over their data and digital identities. Today, much of our online activity is tracked and stored by large companies, which can lead to privacy concerns. With blockchain and Web 3.0, your personal information and identity
are protected and managed by you, not a big corporation. You decide what data to share and when, keeping your digital life more secure and private. This technology also allows for new ways to prove who you are online through decentralized identifiers. Imagine logging into a virtual world or a website without creating a new account every time. Instead, you use a digital identity tied to your blockchain wallet, making interactions smoother while still safe. The potential for this new internet is huge. We can imagine a future where artists get paid fairly for their work, gamers truly own their in-game items, and people around the world can connect in ways never before possible. Education, business, entertainment, and social connections may all change dramatically within these decentralized virtual spaces. Of course, with all this excitement, there are still challenges to overcome. Blockchain networks today can be slow and expensive to use for large numbers of users or complex virtual environments. Developers are working hard to improve speed, lower costs, and make the technology more accessible for everyone.
Additionally, creating interoperable systems that allow different virtual worlds to connect smoothly is a major goal, but not an easy one. Despite these hurdles, many believe blockchain will remain a key foundation for building the metaverse and Web 3.0. It brings trust, ownership, and democratization to how we interact with digital spaces, things badly needed as we move to a more connected and virtual future. In summary, blockchain acts like the digital scaffolding for creating the metaverse, a shared, user-controlled universe online. It enables true ownership, secure identity, and new economic models that put people, rather than companies, in charge. The journey is just beginning, but the possibilities are vast, and the world is watching as this new internet takes shape before our eyes. The partnership of blockchain with the metaverse and Web 3.0 could reshape how we live, work, and play in the years to come, promising an exciting future where everyone has a seat at the digital table. Part 12. The Future of Blockchain with Layer 2 and Cross-Chain Solutions. Now that we have explored the basics of Layer 2 solutions and cross-chain interoperability, let's talk about why these innovations matter so much for the future of blockchain technology. Imagine a world where your online transactions are not only secure, but also lightning fast and cost almost nothing. This is the promise these technologies offer, by solving some of the biggest challenges blockchains have faced. Blockchains like Bitcoin and Ethereum, while revolutionary, have always struggled to handle a large number of transactions quickly and cheaply. Every time you make a transaction directly on the main blockchain, it has to be verified by all the network participants, which takes time and energy. This leads to delays and higher fees, problems that become more noticeable as more people use the network. Layer 2 solutions step in to fix this by moving many transactions off the main blockchain, but still keeping the security of the main chain through clever methods. This means they get the best of both worlds: fast and affordable transactions without sacrificing trust and security. One key idea in Layer 2 is called side chains. Think of side chains as separate highways next to the main blockchain road. Cars, or in this case transactions, can drive on these side highways to avoid traffic jams, then safely return to the main road when needed. These side chains can operate faster and cheaper
because they don't need to involve the entire network for every step. This method allows blockchains to handle many more transactions than before, making the whole system more scalable. Another exciting Layer 2 technology is called roll-ups. Roll-ups bundle lots of transactions together and present them as one to the main chain. This batching approach reduces the amount of data that the main blockchain needs to process. It's like sending many letters in one big envelope instead of many tiny envelopes. By rolling up transactions, blockchain networks can increase throughput and reduce fees, all while maintaining the same level of security.
But speed and cost are only part of the story. For blockchain to really become part of everyday life, different blockchain networks need to talk and work together smoothly. This is where cross-chain interoperability shines. Imagine if your different social media apps couldn't share posts or messages with each other. That would be frustrating, right? The blockchain world had a similar problem. Different blockchains operated independently, making it hard to use one token or asset across several platforms. Efforts in cross-chain interoperability have created bridges and protocols that connect separate blockchains, allowing them to exchange information and value. This means you can send digital assets from one blockchain to another, or use a service built on one chain while holding assets on another. These bridges work like translators or connectors, making the blockchain ecosystem more unified and user-friendly. These advancements come together to make blockchain technology practical for everyday uses, whether it's buying goods, managing digital identities, or even participating in complex financial systems called DeFi, or decentralized finance. Thanks to Layer 2 scaling solutions and cross-chain interoperability, users won't have to worry about slow transactions or high costs anymore. Instead, they can enjoy quick access to services and seamless movement of assets across different platforms. Looking ahead, developers and researchers continue to improve these systems. New projects aim to create even more efficient roll-ups, safer sidechains, and stronger cross-chain bridges. The goal is to build an open, scalable, and interconnected blockchain network that anyone can use easily. This vision could transform industries beyond finance, like healthcare, supply chain management, gaming, and more. To sum up, Layer 2 scaling solutions and cross-chain interoperability are key innovations making blockchains faster, cheaper, and more connected. They break down barriers and bring us closer to a world where blockchain is smooth and simple, where the friction and delays of today are a thing of the past, and where these powerful technologies quietly work behind the scenes, making our digital lives better every day. So as we rest tonight, we can dream about a future where blockchain is smooth and simple, where the friction and delays of today are a thing of the past, and where these powerful technologies quietly work behind the scenes, making our digital lives better every day.
As the world of cryptocurrencies and blockchain technology continues to evolve, governments across the globe find themselves at a crossroads. They understand the enormous potential this technology holds, but also recognize the challenges it presents in terms of security, financial stability, and consumer protection.
Because of this, many governments have started to develop frameworks and regulations to better manage cryptocurrencies and blockchain innovations. One of the key reasons for regulation is to create a clearer legal landscape. Without clear rules, businesses and investors often feel uncertain about the risks and potential liabilities involved. By laying down guidelines, authorities aim to provide a safer environment where innovation can thrive and users can feel more confident engaging with these new technologies. For instance, some countries have established licensing systems for crypto exchanges, requiring them to adhere to anti-money laundering standards. Others have introduced tax regulations that clarify how profits from cryptocurrencies should be reported. At the same time, institutional investors and large corporations are increasingly stepping into the crypto space. This growing interest marks a significant shift from the early days when cryptocurrencies were seen predominantly as a niche market for individual enthusiasts. Now, banks, hedge funds, insurance companies, and multinational corporations are actively participating in crypto markets. They realize that blockchain-based assets offer not just new investment opportunities, but also ways to enhance operational efficiency and transparency. The influx of institutional money has had a stabilizing effect on the market. With more established players involved, there's a greater demand for clearer regulations and safer business practices. Institutions often have to comply with strict internal controls and regulatory standards, so their participation encourages crypto businesses to raise their own compliance levels. This trend reduces some of the volatility that has historically made cryptocurrencies risky in the eyes of mainstream investors. Clearer regulations also help boost the legitimacy of cryptocurrencies and blockchain projects. When governments recognize and regulate these assets, it signals to the wider public that this technology is not just a passing fad or a tool for illicit activity. Instead, it is becoming an accepted part of the global financial system and innovation landscape. This legitimacy opens the door for more widespread adoption and integration into everyday business operations. Many major companies have started incorporating blockchain technology into their models, seeing its potential to improve transparency, reduce costs, and streamline processes. Take, for example, Walmart. The retail giant uses blockchain to enhance food safety and traceability. By tracking products on a transparent and tamper-proof ledger, they can quickly identify where an item came from and whether it meets safety standards. This reduces waste and protects consumers from contaminated goods. Another example is IBM. The company has been a pioneer in developing blockchain solutions tailored for businesses. Their IBM Food Trust platform is a collaborative effort that connects growers, processors, distributors, and retailers using blockchain technology. This helps create a more efficient and reliable supply chain, letting partners share information securely and in real time.
Financial institutions such as J.P. Morgan Chase have also embraced blockchain. J.P. Morgan created JPM Coin, a digital token designed to facilitate quick and secure payments between its clients. This private blockchain network speeds up settlements and reduces the costs associated with traditional payment systems. By integrating cryptocurrency principles into their operations, banks are tearing down barriers and improving the customer experience. In the insurance sector, companies are exploring blockchain for claims processing and fraud prevention. Smart contracts can automatically verify conditions and trigger payments without manual intervention. This automation reduces paperwork, shortens processing times, and limits the scope for error or fraud. These examples highlight how clearer regulatory frameworks, combined with growing institutional adoption, are helping bridge the gap between innovation and practical use. Regulations provide the guardrails necessary to protect stakeholders, while institutional involvement drives professionalism and trustworthiness in the market. The big picture is that cryptocurrencies and blockchain are no longer just experimental technologies. They are becoming key tools in modern business strategies around the world. Governments and institutions working together to shape their development is a critical part of this story. As regulations become more defined and companies continue to innovate, the future of crypto looks more promising, secure, and integrated than ever before.
Now let's dive into some fun facts and surprising stories from the blockchain world that might just surprise you and make you appreciate this technology even more. First off, did you know that Bitcoin, the original cryptocurrency, has a supply limit of exactly 21 million coins? This means that no matter how popular Bitcoin becomes or how many people want it, there will never be more than 21 million Bitcoins in existence. This cap was built right into the Bitcoin protocol by its mysterious creator, known only as Satoshi Nakamoto. The idea behind this limit was to create scarcity, somewhat like digital gold, so Bitcoin could hold value over time. As of today, about 19 million Bitcoins have already been mined, but it's estimated that the last Bitcoin won't be mined until around the year 2140. That's because mining rewards get smaller over time, making it harder to find new blocks. So, even though Bitcoin is over a decade old, the process of discovering new coins will keep going for more than 100 years into the future. Next, let's talk about some curious stories involving lost Bitcoin. Because Bitcoin is stored in digital wallets that are protected by private keys, if you lose your private key, you lose access to your Bitcoin forever. It's like losing the only key to a safe, but the safe is digital and impossible to open without that key. One of the most famous cases is a man named James Howells, who accidentally threw away a hard drive containing 7,500 Bitcoins back in 2013. At Bitcoin's current price, that lost stash could be worth hundreds of millions of dollars. Unfortunately, even though he knows where the hard drive might be, in a landfill, digging it up is costly and difficult, and there's no guarantee the data can be recovered. This story warns us about how important it is to carefully back up and protect private keys. There are also stories of people losing millions of dollars worth of Bitcoin because they forgot passwords or lost hardware wallets. This quirky but costly side of crypto keeps reminding us how different and sometimes risky it is compared to regular money. Beyond Bitcoin, the blockchain space is packed with silly, creative, and sometimes strange projects that show how playful and experimental the community is. For example, did you ever hear about the Crypto Kitties? This was a blockchain-based game launched in 2017 where users could collect, breed, and trade digital cats.
Each CryptoKitty is unique and stored on the Ethereum blockchain, making them the earliest example of what's now called non-fungible tokens, or NFTs. People started spending thousands and even millions of dollars for rare CryptoKitties, turning digital cats into valuable collectibles. The game's popularity even caused network congestion on Ethereum for a while, showing how one quirky idea could impact a whole blockchain. There are also projects that use blockchain technology for completely practical or unusual purposes.
For instance, some companies use blockchains to track the origin of food and products, ensuring customers get honest information about where and how items were made. Others experiment with using blockchain for things like digital identities, voting systems, or even creative storytelling in video games. Blockchain's ability to provide a secure, transparent, and permanent record makes it great for many uses beyond just money. Now, it wouldn't be a story about blockchain and crypto without mentioning the unique culture around it. The world of crypto enthusiasts is full of interesting characters, memes, slang, and traditions that make it quite different from traditional finance. For example, crypto fans often refer to Bitcoin as digital gold, or even just BTC, while calling themselves hodlers instead of traders or investors. Hodl started as a typo in an online post, but turned into a popular term meaning hold on for dear life, encouraging people not to sell their Bitcoin even in tough times. You'll also find lots of humor and memes involving rockets, moons, and lasers, because saying a coin is going to the moon means its price will rise a lot. People share jokes about to the moon so often that it's become part of crypto's culture and community identity. Many crypto forums and events have a fun and inclusive vibe where people celebrate wild ideas, funny moments, and the possibility of a new financial future. In fact, the blockchain community is so vibrant and sometimes quirky that it feels like a blend of tech geeks, investors, artists, and dreamers, all aiming to reshape how we think about money, trust, and ownership. From massive conferences to online chat groups, the human side of blockchain reveals a world that's constantly experimenting, learning, and having fun while working on serious innovations. So these fun facts and surprising stories remind us that the blockchain world isn't just about technology or finance. It's a story full of adventure, creativity, and occasionally a little bit of chaos. From the fixed supply of Bitcoin and lost digital fortunes to digital cats and meme-filled communities, blockchain continues to surprise us and inspire millions of people around the globe. And who knows what the next big quirky project might be? The world of blockchain is always ready to surprise us next. As we gently look toward the future of blockchain and cryptocurrency, it's truly fascinating to imagine where this journey might take us. One exciting path lies in the evolution of something called Decentralized Autonomous Organizations, or DAOs. Think of DAOs as communities without a boss, where decisions are made by members using blockchain technology rather than by a single leader or company. This could change how people work together, run businesses, or even manage entire communities. It's like having a group that can govern itself, with everyone's voice heard through transparent, secure voting on the blockchain. Another important area to watch is how blockchain technology will improve in terms of scalability and privacy. Right now, one challenge with many blockchains is how quickly and cheaply they can handle transactions. Imagine using the technology for everyday tasks, like buying a coffee or paying for a bus ticket. To get there, these systems must become faster and more energy efficient. Developers are working on solutions that can handle thousands or even millions of transactions per second, making blockchain as smooth and reliable as the usual apps we use every day. Privacy is another key point. While blockchains are public ledgers, meaning anyone can see transactions, there are new advancements that protect people's private information while still keeping everything honest and transparent. This means, in the future, you might be able to enjoy secure, confidential interactions online without worrying about who's watching. Beyond these technical improvements, the potential for blockchain to impact our daily lives is vast, far beyond money and finance. Imagine secure digital identities that keep your personal data safe, health records that you control and can easily share with doctors, or even ways to prove where a product really comes from, ensuring what you buy is genuine and fairly made. These examples show just the beginning of what's possible. What's truly beautiful about this space is how quickly it changes. New ideas, better technology, and fresh ways for people to connect continue to emerge. That's why it's important to stay curious about blockchain and cryptocurrency. Even if it all feels a bit mysterious or complex at times, being open to learning can open many doors. Whether you're an expert, a beginner, or just someone intrigued by the possibilities, the future holds endless opportunities to discover and grow. So as you settle down and prepare to rest, let your mind wander gently over these ideas. Think of the world quietly moving forward, building a future where technology helps make life smoother, safer, and more connected. Tomorrow is full of promise, and the story of blockchain and crypto is still being written, one block at a time. Rest well, knowing that innovation never sleeps, and neither does the spirit of human creativity.